Dreaming is not enough. All of us have long-term financial goals, be it child's education, marriage, secure retirement, etc. Investment decisions that we take now will help us build a promising future. The earlier you begin investing, the more time your investments are likely to grow through compounding. In the following few minutes, we will discuss why we need to invest regularly and for the long term. Inflation is a big worry for investors. If it isn't already, then it should be. A sustained increase in the general level of prices is known as inflation. Put simply, inflation is the reason your money can no longer buy the things it used to. An MBA that cost rupees 4.5 lakhs in 2005 is at rupees 17 lakhs in 2015 and is estimated to rise to rupees 64.2 lakhs in 2025. As aspirations rise and as everyone around you aspires to a higher standard of living, you will find your family is no different. Be it travel, eating out, holidays, or higher education. Everything has become far more expensive, meaning yesterday's luxuries have become commonplace items today. Over the years, the amount you spend on monthly household expenses will be very different from what it is today. As per our internal research, at 6% inflation, today's monthly household expenses of rupees 50,000 could end up at over rupees 1.6 lakhs in 20 years. At 10% inflation, it will be over rupees 3,36,000. You will agree, this kind of increase is not easy to deal with. After all, incomes are not guaranteed to keep pace. Hence, you need to plan and make preparations to fund your future needs. With the power of compounding, sometimes referred to as the eighth wonder of the world, you can make money grow significantly over time. This is because you are reinvesting the money you made in an investment. It is like money earning more money. An investment of rupees 10,000 a month can grow to rupees 23 lakhs over 10 years. Assuming a 12% return, the rupees 12 lakh capital investment leaves you with a corpus of rupees 23 lakhs over 10 years. If you continue investing for another 10 years, your capital investment will be another rupees 12 lakhs. But your wealth over this period will grow to rupees 99 lakhs. By increasing your capital by just rupees 12 lakhs over 10 years, your wealth rises by rupees 76 lakhs. That is 6 times the investment. It is important to choose the right asset class to invest. Compounding works best when you invest in the asset class that is best suited to perform over the long term. Data across multiple markets and time periods have shown that equities is the best performing asset over long time frames like 5 and 10 years. While equity tends to have short-term blips, it delivers over the long term, provided you choose the right way to invest into equities. As per Bloomberg reports, over the last 15 years, equities have grown at 13.3% CAGR, even though there would have been one-year periods where the returns were negative. Over this period, inflation grew at 7% CAGR, which means that most assets barely did better than inflation. Clearly, equities are the best choice if you need to invest for longer periods and also need to generate returns that beat inflation by a decent margin. Getting a head start works to your advantage in most things in life, and investing is no different. Investors who begin early end up with a bigger pool of savings. Let's understand the benefits of an early start with an illustration. Deepika has started earlier than Madhuri. She begins investing at 28 years, rupees 5,000 every month in an investment that returns 12% CAGR. Madhuri also wants to invest like her friend Deepika, but she is 20 years behind. To make up for lost time, Madhuri increases her monthly investment to rupees 15,000 a month. With this, both have invested rupees 18 lakhs by age 58 years. Age 58, Madhuri ends up with rupees 25 lakhs. Deepika accumulates rupees 1.74 crores. The 20-year head start has helped Deepika generate a corpus nearly 7 times larger than Madhuri. As an asset class, equities have posted the best performance over long terms. We have seen that already. Equity funds are managed by professional fund managers whose job is to identify and maintain an appropriate equity portfolio. Think of this in much the same way you leave certain matters to professionals, be it doctors, tax consultants, lawyers, etc. There is a way of investing into equities as an asset class in a disciplined and consistent manner. It is called Systematic Investment Plan, or SIP in short. Whether you're a retail investor or a high net worth investor, SIP is the ideal way to invest into equity. With automatic investing, the investor develops the knack and discipline of investing regularly, come what may. Investors often agonize about investing at market lows. With SIPs, you get a good mix so that over time, your cost of investment averages out. This is known as rupee cost averaging. There is the benefit of compounding as you invest for a long period, say 5 to 10 years at least. SIPs and mutual funds have become the preferred mode for planning and realization of long-term financial goals. Please walk into your nearest bank branch or talk to your financial advisors to start an SIP today. Few important disclosures. The examples provided are solely for information purposes and have no connection whatsoever with any scheme of Baroda Pioneer Mutual Fund. SIP does not assure a profit or guarantee protection against loss in a declining market. It should not be construed as a promise on minimum returns and safeguard of capital. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. An investor education initiative by Baroda Pioneer Mutual Fund.